So right now, VOO, QQQ, and SCHD are quietly becoming the three ETFs that millions of Americans are building their entire portfolios around. And once you understand why this specific combination works, and more importantly, how to split the money between them based on where you are in life, you'll see exactly why. Because this isn't a trend. The data behind it goes back 20 years. Here's the number that reframes everything. Because once you see it, the logic behind this whole strategy clicks into place instantly. Over the past 20 years, 91% of actively managed funds failed to beat a simple S&P 500 index. Not during a bad year. Not during a crash. Over a full 20-year stretch. These are funds run by people with Ivy League MBAs, teams of analysts, and salaries most of us will never see. And 9 out of 10 of them still lost to a computer that just buys everything and does absolutely nothing else. In fact, 2024 was the 15th consecutive year where the majority of large-cap fund managers couldn't keep up with the S&P 500. 15 years in a row. So the real question was never which stocks to pick. It was always about fees, structure, and discipline. And that's exactly what VOO, QQQ, and SCHD give you, in a combination that most people are quietly assembling wrong. And the gap between investors who get this right and investors who don't usually comes down to one thing: fees. Here's what that actually looks like in real life. My colleague Marcus had been putting money into a portfolio his advisor built for him for years. Consistent saver, decent income, doing everything right on paper. But when he actually sat down and added up what he was paying, it came out to 2% annually. His advisor's cut plus the actively managed funds the advisor had put him into. 2% sounds harmless. Almost invisible. But here's what invisible looks like over time. A $200,000 portfolio growing at 9% annually over 25 years. Without those fees, you're looking at roughly $1.7 million. With fees dragging returns down to 7%? Just under $1.1 million. That's over $600,000 gone. Not lost in a crash. Not a bad trade. Just quietly extracted in fees, year after year. That is the problem this three-fund combination solves. Now let's talk about the solution, starting with the foundation of this entire portfolio. So VOO is the Vanguard S&P 500 ETF, and right now it is the single largest ETF on the planet, sitting at approximately $858 billion in assets under management. Investors poured over $120 billion into it in 2025 alone. One fund. One calendar year. $120 billion. That's not marketing. That's millions of investors, institutions, retirement accounts, everyday people, all independently looking at the data and arriving at the same conclusion. So what are you actually buying? Think of it like this. When you own VOO, you own a tiny piece of every major industry driving the American economy. Technology, healthcare, finance, energy, consumer goods, all of it in one ticker. Nvidia leads the holdings at around 7.84%, followed by Apple just under 6.4%, Microsoft at 5.3%, then Alphabet, Amazon, Broadcom, Meta, Tesla, and Berkshire rounding out the top 10, which together account for nearly 40% of the entire fund. Now here's something most people don't realize about VOO today. The biggest sector is technology at 33.4%. 10 years ago that number was just 20%. So the S&P 500 has been quietly transforming into something far more tech-heavy than most investors realize. It's less a diversified basket of America and more a tech fund with a diversified side dish. That's not necessarily a problem, but it's something you need to know going in because it changes how you think about the other two funds. Expense ratio is 0.03%. $3 a year per $10,000 invested. The 10-year average annual return sits at 15.53%. So VOO is the backbone. Steady, broad, quietly compounding whether markets are going up or sideways. But with tech now at 33% of the fund, the diversification has limits. And that's exactly where the next two funds earn their place. So if VOO is the foundation, QQQ is the accelerator. This is the Invesco QQQ, tracking the Nasdaq 100. The 100 largest non-financial companies on the Nasdaq. Where VOO's tech exposure sits at 35%, QQQ pushes that above 51%. And before that sounds like a red flag, Here's the performance reality. QQQ has beaten the S&P 500 7 out of the last 10 years as of the end of 2025. 7 out of 10. And since its inception back in 1999, the cumulative outperformance over the S&P 500 is over 556%. That's not a short-term data point. That's a structural advantage built on the fact that the most innovative, fastest-growing companies in the world tend to list on the Nasdaq. AI, cloud computing, semiconductors, e-commerce, that's QQQ's neighborhood. Current AUM is around $393 billion. And here's something worth knowing. QQQ just went through its first major structural upgrade in 25 years. It converted from an older unit investment trust format to a modern open-ended ETF, which dropped the expense ratio from 0.20% to 0.18% and now allows the fund to reinvest income and engage in securities lending. Same Nasdaq, 100 exposure. Better structure going forward. Top holdings are nvidia at roughly 9%, Apple at 7.3%, Alphabet around 7%, Microsoft at 6.1%, Amazon at 5%, with Meta, Tesla, Walmart, and Broadcom rounding out the top 10. Those top 10 alone account for nearly 50% of the fund. So you're getting highly concentrated exposure to the companies at the absolute center of the AI build-out happening right now. But here's the honest part, and this is important. That same concentration that drives the outperformance also drives the pain when things go wrong. In 2022, QQQ dropped close to 33%. Think about what that feels like. You put in $40,000. You watch it become $27,000. Anyone holding only QQQ at that point felt every bit of it. Which is exactly why the third fund isn't optional. It's structural. It's the reason the whole portfolio doesn't fall apart when growth takes a hit. So here's the data point that genuinely surprised me when I first came across it. From early November 2025 through early February 2026, roughly 3 months, SCHD returned 17.53%. Over that exact same period, SPY was essentially flat at negative 0.15%, and QQQ dropped 4.79%. SCHD outperformed QQQ by over 22 percentage points in 3 months. While tech names were sliding off their peaks, while AI stocks were pulling back, while the biggest names in the S&P 500 were sitting an average of 15% below their 52-week highs, SCHD was quietly hitting all-time highs. And this wasn't luck. It was the fund doing exactly what it was built to do. The index runs a strict quality filter that most companies simply can't pass. To get in, a company needs at least 10 consecutive years of dividend payments, strong cash flow relative to debt, solid return on equity, and a proven history of growing those dividends. It's not chasing high yield. It's owning businesses that have been generating reliable cash through recessions, rate hikes, and pandemics, and kept raising their payouts through all of it. Current AUM sits around $79 billion. Expense ratio is 0.06%. Dividend yield is approximately 3.3% right now, paid quarterly. And the 10-year dividend growth rate is 10.72% annually. So you're not just collecting a yield, you're collecting a yield that has historically grown at over 10% a year. Someone who bought SCHD back in 2020 at a split-adjusted price around $17.50 is now sitting on a yield on their original cost of nearly 6%. That's what dividend compounding actually looks like when you let it run. But here's what really makes SCHD irreplaceable in this combination. Look at the sector breakdown. Technology is less than 10% of SCHD. The dominant sectors are energy, consumer staples, healthcare, and industrials. Now compare that to QQQ, where tech is above 50%. These two funds are almost mirror images of each other. Where one struggles, the other tends to hold. It's like having two employees, one who thrives in good times and one who shows up hardest when things get difficult. You want both on the payroll. In 2022, when nvidia, Tesla, and the big growth names were down 70% or more at their lows, SCHD ended the year in positive territory. When growth is thriving, VOO and QQQ carry the portfolio. When growth hits turbulence, SCHD holds it together and keeps paying you a growing dividend while it does. That's the balance you're engineering. So here's where most people quietly get this wrong. They treat allocation like a one-size-fits-all answer. But the right split between these three funds isn't about which one is best. It's almost entirely about one thing: your time horizon. Think of it like this. Allocation is the dial between growth and stability. Turn it one way and you're maximizing what the portfolio can become. Turn it the other way and you're protecting what it already is. Where you set that dial should change as you get closer to needing the money. So here's a clean framework. If you're in your 20s or 30s with 25 plus years before you need this money, a strong starting point is 40% VOO, 40% QQQ, and 20% SCHD. Maximum growth exposure while you still have the runway to absorb volatility. A rough year in tech will hurt more, but you also have decades of compounding ahead, and that's where the real wealth actually gets built. If you're in your 40s, consider shifting to 40% VOO, 30% QQQ, and 30% SCHD. Still growth-oriented, but you're building more defensive income and reducing how much a rough year in technology can damage the whole portfolio. And if you're within 10 years of retirement, something closer to 30% VOO, 20% QQQ, and 50% SCHD starts making a lot of sense. SCHD's quarterly dividends begin replacing what a paycheck used to do. The volatility comes down meaningfully, and you're still getting equity-driven inflation protection that bonds simply cannot match right now. So once the allocation is set, there are two moves that cost nothing to implement and that most investors either don't know about or never actually follow through on. The first is rebalancing. Let's say your target is 40% QQQ. After a strong run in tech, it drifts to 48% of your portfolio. Rebalancing means trimming QQQ and adding to SCHD, systematically selling what's gotten more expensive and buying what's gotten relatively cheaper. It sounds almost too simple. But research consistently shows this disciplined approach adds 0.5 to 1% to annual returns without taking on any additional risk. That might sound small, but on a $300,000 portfolio over 20 years, that compounds into something that changes the final number significantly. The second is tax efficiency, and this one is baked directly into these funds without you doing anything at all. In 2023, only 2.5% of all ETFs distributed capital gains to shareholders, compared to over 31% of mutual funds. For someone in the 24% tax bracket, that difference over a decade translates into tens of thousands of dollars that stay in your account instead of going elsewhere. So the full picture looks like this. VOO as the backbone, steady, broad, the American economy in a single ticker. QQQ as the growth engine, concentrated, tech-tilted, built around the companies driving the next decade. SCHD as the stabilizer, defensive income, low volatility, holding the portfolio together when the other two are under pressure and paying you a growing dividend while it does. 3 funds. A clear logic for how to split them based on where you are in life. And fees so low they stop being a headwind and start working quietly in your favor every single year. And if you want to keep building on this, YouTube is already lining up the next video for you. I'll see you over there.